SIFMA is a leading trade association representing broker-dealers, banks, and asset managers in the U.S. and the global markets. We advocate on regulation, legislation, and business policy impacting the equity and the fixed income markets, as well as related products and services. We serve as a coordinating industry body to promote informed regulatory compliance, resiliency, and efficiency in the markets. We also provide forums for industry discussion and education, and we have offices in New York and Washington, D.C., and we are the U.S. regional member of the Global Financial Markets Association. The CAT went live back in July of 2020, and at this stage, all of the transaction data is resident in the system. That phase has been completed, and we're working now towards phase 2E. And at that point in time, broker-dealers will be implementing what's known as the Customer and Account Information System. And within that new system will be included the personally identifiable information, or PII, of every retail and institutional investor in the United States. As you can imagine, CAT just has a treasure trove of information, given all of that trade and the related data, including who is the ultimate owner of those securities. And that can also be potentially harmful as well, given the breadth of that information within the system. The system, as directed by the SEC, was built by 25 SROs, which are self-regulatory organizations, many of which are part of larger publicly traded companies. We are concerned because once the data leaves the broker-dealer systems and goes into the CAT, it's really incumbent upon FINRA CAT as well as the exchanges to protect that data. And they do have the ability under the current rule to download that data into their own systems, which really means that the protection of that is incumbent upon the thousands of employees working at those exchanges. The SEC had issued a proposal back in August of 2020 by then Chair Clayton, which was really designed to protect the CAT. And this was a proposal that SIFMA had really been advocating for and was very pleased to see. It has really important things included in it, including a prohibition against those very exchanges from bulk downloading that data and mandating that they access the data within FINRA CAT in a secure analytical workspace, which we think would really give the data much more security and protection, because there would only be one party that's responsible for it, as opposed to being downloaded. And as we view it, the weakest link is really a vulnerability there. The rule also would codify that CAT data can only be used in regulatory purposes. And again, we think that's critically important. The exchanges are for-profit companies. They compete with our members, and the data that they could gain from that to use in a filing would certainly have both commercially and regulatory implications there. So we think that's important to see that finalized. SIFMA'S really has spent significant time this year both addressing the proposals. So far this year, we've seen 20 proposals come out of the Commission, 12 of which impact our members and are proposals that we've commented on. And from what we've heard from the Commission, there could be as many as 50 proposals coming this year. And we're certainly very concerned because as part of the SEC's own rulemaking process, they really need to go through a series of steps. And the first is really engaging with the stakeholders, whether that be the buy side, the sell side. They really need to understand first what the problem is that they're solving for and how the industry thinks solutions could be crafted. And that's so critically important because what we're seeing now is we're seeing all of these proposals come out, but we're not engaged in the discussions before we see them. Additionally, these proposals have very short comment periods, 30 to 60 days, and given the significance of these proposals, which could really have very systemic changes on the markets, and just the complexity and the interrelated nature of them. We do think it's important that they have longer comment periods so that the stakeholders can really digest what's included in it, perform an economic analysis to see if this new rulemaking is really worth the expense of it. And then once those comments are filed, we again think it's critically important that the SEC have the opportunity to review all of those comments and perform their own analysis, economic cost analysis, to determine whether those those proposals should go forth into rulemaking. And, we're concerned that without this happening, some of these proposals and their complexity, as well as the interrelated nature of them, for example, the Reg ATS proposal, which we recently commented on, a subsequent proposal looking at whether certain traders should be registered as dealers. And, it was very interesting because once the comments were filed on Reg ATS and the dealer proposal came out, we actually saw the SEC reopen the comment period on this proposal, the Reg ATS proposal. And we think they did it because there are connections between the proposals. And we, think they may have recognized that without going back and opening this up for comment, there could be important things that they need to consider here, which might not have been contemplated when they drafted that proposal. So again, just the complexity and the nature of how they're linked together suggests that more time is needed here. The markets have been incredibly resilient, really a testament to the industry, the exchanges, the clearing utilities, things that we were unprepared for a number of years ago with Hurricane Sandy. We've really made great strides and improvement. And when COVID hit in March of 2020, Wall Street went home. We had certainly tested working remotely, but never on the magnitude that we did back in March of 2020. We saw extreme volatility in the markets, 1,000-point movements. We saw the market-wide circuit breakers triggered on 4 separate occasions, and the markets worked. We were able to work through the few hiccups that had occurred. But again, the fact that we were able to keep the markets open, there had been discussions, do we need to shorten the trading day? Do we need to just close the markets entirely? And we didn't, which again, I think is just a testament to, all of those professionals who are engaged in it, and really a very positive sign that we were able to keep them open. And yes, indeed, they were resilient. We went out and we surveyed our members earlier this year. We surveyed our listed options as well as our equity markets and trading committees and the exchanges as well, really trying to see what their thoughts are on a number of different aspects of markets right now. And certainly one of them we looked at was retail participation. And what the majority of the survey showed was that retail participation in 2021 was it was about 30 to 40%, which was an increase over 2020 when our members had thought that those levels were probably closer to 20 to 30%. Similarly, in the equity markets, last year our members thought participation was about 20 to 30%. So I personally found that very interesting to see how retail participation has shifted, and so many investors are engaged in the markets today. We did ask our members, what do you think about the future? Will retail participations, remain at these heightened levels? And, on both the equity and the options side, the prediction was we're going to see a decrease in that. What's really driving that? The number one answer, and we've heard this, throughout the conference, is $0 commissions. That's really been a critical thing. And when everybody was home at COVID, I think the combination of $0 commissions, the enhanced technology and access to apps, And I think critically important, the education that's available to investors. We heard one of the panels yesterday talk about how they have online content, they have YouTube videos, they do in-person conferences and events to teach their customers. And they have coaching, which I really found astonishing because, I mean, that's really a personal level of engagement, again, to make sure that investors are making informed decisions and understand the investments that they're making. I think in terms of seeing this activity maintain, folks definitely indicated that $0 commissions, again, are going to be critically important. And the last thing that our members, that folks had indicated, a positive investing experience and upward momentum in the markets, and certainly in 2021, in 2020 and 2021, we did see a lot of growth in the markets, and I think that created a positive experience for investors. So I think given a lot of the events that we're seeing globally now, the war in Ukraine, inflation, and the pressure that that is having on the markets, I think we have seen retail perhaps to a small degree step a bit to the sidelines. But, you know, again, I think if we do continue to have this good experience, I think in the long term it should bode very well for retail investors.